Good morning. Today we are initiating a deep dive technical and fundamental analysis of Deckers Outdoor Corporation, ticker symbol DECK. As a standout performer in the consumer discretionary sector, Deckers has decoupled from broader footwear weakness, driven primarily by the parabolic rise of the HOKA brand and the resilience of UGG. In this presentation, we will dissect the company's revenue composition, analyze the shift toward direct-to-consumer channels, and evaluate the sustainability of current valuation multiples. We will conclude with a rigorous risk-reward assessment suitable for institutional portfolio construction. Our investment thesis rests on three pillars: brand heat, channel mix shift, and operating leverage. Deckers is currently executing a textbook growth at a reasonable price strategy, despite trading at premium multiples. The core driver is the HOKA segment, which is effectively stealing market share from legacy incumbents like Nike and Adidas in the performance running category. Simultaneously, management's aggressive pivot to direct-to-consumer, or DTC, is structurally elevating gross margins above historical averages. We view DECK not just as a shoe company, but as a high-efficiency capital compounder. Let's isolate the revenue drivers. The portfolio is essentially a tale of two cities, UGG and HOKA. UGG provides the stable, cash-generative base, though it remains subject to seasonal cyclicality and fashion trends. HOKA, conversely, is the growth vector, exhibiting revenue growth rates consistently in the double digits. The strategic imperative here is the diversification of HOKA beyond running into lifestyle and trail, thereby increasing the total addressable market. Investors should note that HOKA is rapidly approaching parity with UGG in terms of total revenue contribution. Quantitatively, the top-line performance is robust. We're looking at a 5-year revenue CAGR exceeding 15%, a rarity in the apparel space. Recent quarterly reports confirm that inventory levels are normalizing, which is a critical liquidity indicator. What matters most to the institutional eye is the quality of this revenue. Full-price selling remains high, with promotional activity significantly lower than peers. This pricing power is a direct result of inventory scarcity tactics and high brand desirability. Turning to the P&L, Deckers boasts a gross margin profile that is the envy of the sector, hovering above 50%. This is the mathematical result of the channel mix shift I mentioned earlier. Every unit sold via DTC captures the full retail margin, bypassing the wholesale discount. Furthermore, operating margins are expanding as SG&A leverage kicks in, meaning revenue is growing faster than the cost base. This operating leverage is the key to EPS outperformance. When we benchmark DECK against the peer group, specifically Nike, On Running, and Skechers, the data reveals a specific niche. While On Running, ticker ONN, trades at a higher speculative multiple due to its nascent stage, Deckers offers a blend of maturity and growth. Unlike Nike, which is struggling with innovation stagnation, Deckers is in an innovation supercycle. The company effectively bridges the gap between the value play of Skechers and the hyper-growth valuation of On Holdings. Valuation is where the debate heats up. Deckers typically trades at a forward PE ranging between 25 and 30 times. While this is a premium to the S&P 500, it is justified by the PEG ratio, price to earnings growth. If we assume earnings growth remains in the high teens, a PEG ratio near 1.5 suggests the stock is fairly valued, if not slightly undervalued relative to its growth prospects. We are looking at EV to EBITDA multiples of roughly 18 to 20x, which is palatable given the pristine balance sheet with net cash position. The bull case for Deckers is predicated on international white space. Currently, international sales comprise a smaller portion of the mix compared to domestic. The HOKA brand has massive untapped potential in EMEA and APAC regions. If management executes their international playbook effectively, we could see a total addressable market expansion that justifies a significant re-rating of the stock. Additionally, sustained DTC penetration towards 50% of total revenue would structurally reset the margin floor higher. We must strictly evaluate the bear case. The primary risk is fashion risk, specifically regarding UGG. If the brand falls out of the current trend cycle, it becomes a drag on earnings. Secondly, the footwear sector is highly sensitive to consumer discretionary spending. In a recessionary environment, premium sneakers are often deferred purchases. Finally, valuation compression. If growth decelerates even slightly, the multiple will contract sharply, leading to significant drawdown risk. In conclusion, Deckers Outdoor presents a compelling profile for growth-oriented portfolios. The fundamentals are pristine: high margins, net cash balance sheet, and a star asset in HOKA. While the valuation demands perfect execution, the momentum and brand equity suggest the upside trajectory remains intact. We maintain a constructive outlook, viewing dips as buying opportunities for long-term accumulation. Focus on the quarterly DTC metrics as your primary leading indicator.